Hello everyone, Fearfully Greedy here. This video is late because I took a few days off in Japan, but don't worry, this won't become a travel channel. But I thought at least I'd bring one thing that might be related to business and investing. Then I will do a big data summary of the last companies I looked through the last week. And finally, whatever came above everything else. So whatever surprised me a bit more, maybe something that I liked a lot and something that I passed. If you are here for the portfolio at the end, I will do a quick update and celebrate the first double after 4.22 years, passing the 80,000 euros. Like and subscribe if you want to see when the first halving happens. Let's get into it. Please remember, this and all my videos are not to be considered financial advice. Do your own research. Take on a professional to do your research, but this is not financial advice. Japan to me is the most interesting for their tradition and cuisine. This economy has had its ups and downs, but definitely is not what it was. 121 million population, right next to China, both Korea and Russia. Very much east from my scope of the world. Their population is shrinking at this point, very low unemployment. It makes sense. I didn't see a single person not doing something. No homeless anywhere. I'm sure they have them, but I didn't see them. What's curious to me is that I saw a lot of old people working in public jogs, but also running their mom and pop shops. Hands-on, really. I found that Japan has over 50% of the world's 200 plus year old business, and sure, it is an island, but I find it quite unique. And as someone that runs a business that I expect to last at least my lifetime and a long-term investor, the term Shinise touches me. Shinise is a Japanese term for a business that has lasted for at least a century in the same family doing the same thing. And they are some of the most respected things to do in their culture. These companies show that tradition is very important, at least in some sectors. Resilience, perseverance, innovation in tough times especially, a real focus on their craft or products for their core occupation with little pivoting contrary to modern times. I have added to my mental models the Chinese flavor, we could say. If a company has a hint of it, I will try to like it or try to send it. Doing things for the future to last for the long term, reinforcing the business and the relationship between all stakeholders, and if anything, avoiding unforced errors that might damage the business. Of course, capital markets are a different story. I'm fearfully greedy, so let's get on track. Japan over, let's get to the companies. During these last weeks, I took a look at 86 companies, of which I invested in none. 12, I didn't like their setup, business model, competitive strength. 18, I just couldn't figure out why or why not they were competitive. I couldn't, with any certainty, make a guess of how they would look 10 years from now and how competitive they would be then. So I also passed on those. And finally, 12, I deemed too risky for their current debt levels or their client concentration or current product offering. Then I found 28, which I just felt were investable. Maybe at a big discount to their future earnings, but they weren't anything special. Just business that generate cash, have their problems, but will probably be around for a while. I passed on all of them due valuation. The next 17, I liked their business. I think they are above average, and I'd say they have a solid moat around with good barriers to fend off competition. I also passed on all of them for valuation. And finally, I revisited two companies which I think are top business. Still, valuations were rich for one, very rich for one, and somewhat rich for the other, but I also passed on those two. These ones I visited often, and I keep a look at valuation because I love investing in them at the right prices. If I spread the 44 investable business by valuation and quality on a graph, it looks like this. As you know, I like the top right quadrant. The closer, the more the idea pulls me in. I'd like to zoom in on a couple of ideas and why I passed on them. Xiaomi is a company that I always liked. I'm a user of their products. From their founding, they have been a smartphone manufacturer, and bit by bit they have kept adding to categories. If I had to summarize them on what makes them stronger, I would say is delivering way more than you expected. With that I mean that they can be, but not always, competitive on the cutting edge technology, but that's not like their forte. What they do is kill the bottom and the mid segment, giving you way more for less. Another interesting thing is that they are delving into electric vehicles. I don't know if that's one step too far, but it's something that is really interesting. And I always felt that they are very thorough when they go into a new category. I won't agree with every move they have done, as sometimes they have externalized too much, damaging their brand. But when they do it in-house, they seem to be extremely competitive. And their growth seems to be reigniting, with new facilities returning to double-digit revenue growth from old and new segments in the last quarters. By the numbers, it looks a bit pricey. I'm very cheap, to be honest. So I won't buy it today, but it's a company that I want to keep an eye on. I'm actually a bit mad for not buying this earlier last year, as it will probably have fallen into my buying price range. Let's take a look at another very different idea. TelaDoc is a virtual healthcare provider that facilitates online visitation and follow-up from patients with a doctor or a healthcare provider. It grew tremendously during the pandemic, like Carvana, like Naked Wines, and now this growth has slowed, and they are still unprofitable but cash flow positive. A lot of their growth was through acquisitions, and most of their downfall seems to be from that. Bad acquisitions. To be honest, what I really liked was this graph. You know I love this graph. Seeing something people paid 40 billion for 3 years ago and now is selling for 1.5 billion just piques my curiosity. What happened here? They have two segments, TelaDoc Health Integrated Care and BetterHelp. Integrated care is business to business, where they serve hospitals, employers, health plans, insurance, with virtual medical services, including general medical, expert medicals, specialty medical, chronic condition management, mental health. These serve close to 90 members of said service, patients, and have access by fee or per session fee, a monthly fee, depending on the number of patients. BetterHelp is direct to consumer mental health platform of which you probably have seen an ad at some point, or maybe I'm just a good fit for those ads, but they have 40,000 licensed clinicians who do sessions over the phone, web, or app through their video or event text. The patient pays on a monthly basis and gets access to a certain amount of sessions. Trailing 12 months, they have generated 2.6 billion, of which 1.8 were gross profits. That's a start. That's a great margin. Positive note. Let's see if it keeps going. Selling general administrative, it's 1.3 billion of those, and research and development another 3 million, and the rest is amortization and goodwill, intangibles, minus 80 million on operating. Another impairment of goodwill, which after the previous 13 billion impairment in 2022 in this quarter, this is all from their acquisition of Livongo, has erased that from the balance sheet at this point, but it keeps hurting a bit the stock every time they have to do these adjustments. EBITDA is 66 million. If we take their word and go for adjusted EBITDA, it's 350 million a year, with stock compensation taken out, which is 200 million per annum, because that's not a real cost, remember? I'm joking, by the way. Well, shouldn't they be compensated with such amazing performance? Maybe this alignment helps down the road, but 3.7% trailing 12 months dilution. Another big glimpse of hope is they are generating cash, 300 million a year, and this is trading at 1.8 billion enterprise value. So 6 times? Maybe? Big maybe. So is there an opportunity here? The opportunity will be there if this has a real moat and something to combat newcomers, big enough barriers of entry. If not, it could be half the price. I still couldn't really value it. Is there a moat? The issue, if we go by first principle, is that creating a calendar of sessions with healthcare practitioners online and a platform is very easy to replicate. They have a third of the US members, like 90 million. Still, they can't make money. It's probably cheap and at this price, but I do not want to touch it. Their only real moat is their brand and customer relations, as well as first mover advantage, and still I don't think those are very strong. Can they become profitable? Probably, but no idea how much, and the numbers. At this point I will pass and keep looking. Okay, now an update on the portfolio. I haven't sold or bought anything, but I crossed the first double, 4.22 years of project. way above my expectations. As of today, Carvana is half the portfolio, followed by Playmates, Warrior, Naked Wines, Pax, Alibaba, Nacorp, Ra International. If you want to stay tuned and updated, I want to see if I ever go do a halving and go to 20,000, like the video and subscribe. Well, see you soon with new ideas and learnings. Be safe.